Hello and welcome back to the channel. I'm your host, and today we're diving deep into one of the most exciting opportunities in the stock market right now. If you've been feeling priced out of quality investments because share prices have climbed to hundreds or even thousands of dollars, I've got great news for you. We're about to explore 3 stocks trading under $10 that aren't just cheap. They're potentially undervalued powerhouses that could transform your portfolio. These aren't penny stocks or speculative gambles. We're talking about established companies with real revenues, proven business models, and catalysts that could drive significant returns. So whether you're a seasoned investor looking to diversify or someone building their first portfolio with limited capital, make sure you stay until the end because I'll be sharing a complete summary infographic with all the key data you need to make your decision. Let's get started. Before we reveal our first pick, let's talk about why stocks under $10 matter in today's market environment. The stock market has been incredibly volatile lately, and many quality companies have seen their share prices compressed not because of fundamental problems, but due to broader market sentiment, sector rotations, or temporary headwinds. This creates golden opportunities for patient investors who can see beyond the noise and identify real value. When you're buying stocks under $10, your capital goes much further. You can build meaningful positions without tying up massive amounts of cash. If these companies execute on their strategies, the percentage gains can be substantial. Think about it. A stock moving from $5 to $10 gives you a 100% return, the same percentage move that would require a $100 stock to reach $200. But here's what makes today's analysis special. We're not talking about companies on the verge of bankruptcy or businesses with no viable future. The 3 stocks we're covering have real operations, generate actual revenue, and have strategic initiatives in place that could unlock significant value. These are calculated investments with asymmetric upside potential. The current market environment actually favors these types of opportunities. With interest rates stabilizing and economic uncertainty creating selective pressure, the companies that can demonstrate real profitability improvements and strategic vision are being rewarded. We've done extensive research on financials, quarterly reports, partnerships, collaborations, and industry trends to bring you these 3 picks. Each one operates in a different sector, faces unique challenges, and offers distinct risk-reward profiles. What they all share is the potential to deliver outsized returns if management executes on their stated plans. So let's not waste any more time. We're going to start with a company that most people know by name but have completely misunderstood as an investment opportunity. Our first stock is Nokia Corporation, trading under the ticker NOK, currently hovering around $6 to $7 per share. Yes, that Nokia, the company that once dominated the mobile phone industry. But here's what most investors are missing. Nokia isn't in the smartphone business anymore. They've completely transformed into a telecommunications infrastructure powerhouse. They are positioned at the absolute center of one of the biggest technological build-outs of the decade, the global 5G network expansion. Let me walk you through why this matters financially. Nokia's 2024 revenue came in at $19.22 billion, and while that represented a decline from the previous year, the context is critical. The telecom equipment market went through a digestion phase after the initial 5G deployment wave, but Nokia has been strategically positioning itself for the next major growth cycle. Here's where the numbers get really compelling. Nokia is receiving strong analyst support with an average 12-month price target of $6.70, and a high estimate reaching $8.50, with 5 analysts recommending buying the stock. The company's gross margins have been improving dramatically, and they're generating positive free cash flow, which is absolutely critical for a company in a capital-intensive industry. Nokia ended recent quarters with approximately 3 billion euros in net cash on their balance sheet, giving them a fortress-like financial position. This allows them to invest heavily in research and development, pursue strategic acquisitions, and return cash to shareholders through dividends. Speaking of which, Nokia reinstated its dividend, currently yielding around 1 to 2%, which might not sound exciting until you realize many growth-oriented tech companies pay nothing at all. Now let us talk about the business drivers, because this is where Nokia's transformation story becomes truly exciting. Nokia recently announced a major restructuring focused on artificial intelligence, dividing its business into network infrastructure and mobile infrastructure units. They've secured massive contracts with telecommunications providers worldwide for 5G infrastructure deployment. In North America, they're a primary supplier to T-Mobile, one of the most aggressive 5G deployers in the United States. They've expanded relationships with AT&T and have partnerships with numerous regional carriers. The company is planning to expand U.S. investment by $4 billion in research and development and manufacturing for AI-ready network connectivity. In Europe, they're working with major operators across multiple countries, and they're making significant inroads in India, which represents one of the largest telecom markets globally. But the real game changer is Nokia, strategic repositioning around cloud-native 5G architecture and their expansion into enterprise solutions. Nokia isn't just selling equipment to telecom carriers anymore. They're building private 5G networks for industrial customers, developing connected vehicle technology with automotive companies, and creating solutions for smart cities and IoT applications. Their partnership announcements have been impressive. Collaborations with Microsoft on cloud-native mobile networks, agreements with AWS to deliver private 5G solutions, and multiple contracts in the industrial sector with companies like BMW and Lufthansa. Recent partnerships include Nokia working with Party Airtel on 5G capabilities and partnering with Tampnet to expand 5G offshore connectivity in the Gulf of Mexico. These enterprise deals carry higher margins and create sticky, long-term relationships that generate recurring revenue streams. The company's cloud and network services division is showing strong growth, and their software business is becoming an increasingly important part of the revenue mix. From a competitive standpoint, Nokia is one of only 3 major Western suppliers of telecom equipment, alongside Ericsson. With Huawei facing restrictions in many Western markets due to security concerns, Nokia has been a primary beneficiary, capturing market share and securing long-term supply agreements. The geopolitical dimension actually works strongly in Nokia's favor, as governments increasingly view telecommunications infrastructure as critical national security assets and prefer trusted Western suppliers. Moody's ratings changed Nokia's outlook from stable to positive while affirming its ratings, which signals improving financial health and business prospects. For investors, the risk-reward proposition is compelling. You're buying a financially stable company with a strong balance sheet, improving margins, and exposure to a multi-year infrastructure build-out, all at a valuation that prices in significant pessimism. If Nokia executes on their margin expansion plans, continues winning major contracts, and grows their software and enterprise businesses, the stock could easily return to the $8 to $10 range or higher within the next 12 to 18 months. Our second stock operates in a completely different sector and is undergoing one of the most dramatic business transformations you'll see in the market today. We're talking about Pitney Bowes, ticker symbol PBI, currently trading around $10 to $11 per share. Now, I know what some of you are thinking. Isn't Pitney Bowes that old postage meter company? Yes, but that's like saying Apple just makes computers. It's technically true, but completely misses the bigger transformation happening beneath the surface. Pitney Bowes has been executing a massive pivot from traditional mailing equipment into a comprehensive e-commerce logistics, shipping, and cross-border solutions provider. Let me show you the financial transformation that's taking place. Pitney Bowes reported revenue of $2.03 billion for full year 2024, representing a 3% decline from the previous year. Now, before you dismiss that decline, understand what's happening. The legacy mailing business is shrinking as expected, but their e-commerce and shipping solution segments are growing and improving profitability dramatically. In the third quarter of 2024, Pitney Bowes achieved $103 million in adjusted EBIT, representing a 22% year-over-year improvement. This is the key metric that tells you the transformation is working. They're making more money on less revenue because they're shifting to higher margin businesses. The company has been aggressively managing costs, reducing their expense structure by hundreds of millions of dollars through restructuring initiatives, facility consolidations, and operational efficiency programs. They achieved $120 million in annualized savings by the end of 2024, with a target of $170 to $190 million in net annualized savings. Here's where the story gets really interesting from a cash flow perspective. For 2025, Pitney Bowes is guiding for free cash flow between $330 and $370 million. That's substantial cash generation that they're using to pay down debt, invest in growth, and return capital to shareholders. Speaking of which, the company's board of directors authorized a $150 million share repurchase program and increased the quarterly dividend to 6 cents per share, signaling management's confidence in the business trajectory. The balance sheet has been a focus area, and they've made significant progress bringing leverage down to more sustainable levels. They now have no debt maturing over the next 24 months, giving them ample runway to execute their strategy without refinancing pressure. Let's talk about what makes Pitney Bowes interesting beyond just the financial metrics. The e-commerce explosion over the past several years created enormous demand for shipping and logistics solutions, and Pitney Bowes positioned itself right in the middle of that trend. They've built out a comprehensive network of shipping solutions that serve e-commerce sellers, particularly small to medium-sized businesses that need cost-effective ways to ship products domestically and internationally. Their pre-sort services segment has been performing exceptionally well. Pre-sort sorted 3.7 billion pieces of mail in a recent quarter, growing volumes by 3% year over year, with higher volumes and revenue per piece expansion driving revenue growth. This business leverages their extensive logistics network to offer discounted postage rates to businesses, and they handle billions of pieces of mail annually. Their cross-border e-commerce solutions help merchants sell globally by managing the complex logistics of international shipping, customs clearance, and last-mile delivery in destination countries. One of the most strategic aspects of their business is the focus on the middle market, businesses that are too large for simple retail shipping solutions, but not big enough to negotiate directly with FedEx or UPS or build their own logistics networks. This is a massive, underserved market segment, and Pitney Bowes has built capabilities specifically designed for these customers. They offer shipping software, discounted rates through volume relationships with carriers, and value-added services like returns management and package tracking. The company successfully exited their global e-commerce business, which was generating losses of $136 million in 2023. This strategic exit removes a drag on profitability and allows management to focus resources on their core, profitable operations. The company recorded a $164 million tax asset related to this reorganization, which will provide cash tax benefits over the next 3 years. For 2025, Pitney Bowes is guiding for revenue between $1.95 and $2.0 billion, with adjusted EBIT between $450 and $480 million. If they hit these targets, they're looking at EBIT margins approaching 25%, which would be exceptional for a logistics and shipping business. The turnaround thesis is straightforward. Pitney Bowes is transforming from a declining mail equipment company into a profitable e-commerce logistics provider with strong cash generation. They have a new CFO coming on board to help drive the financial strategy forward, and management is focused on improving free cash flow in a sustainable manner. For investors willing to look past the quarterly noise and bet on the execution of this multi-year transformation, the current valuation could represent significant value. If the company continues generating strong free cash flow, paying down debt, and demonstrating that the new business model works at scale, the stock could easily move toward the $15 to $20 range over the next couple of years. The high dividend yield provides income while you wait, and the share buyback program shows management is confident enough to deploy capital on their own stock. Our final pick is the most speculative of the three, but potentially offers the highest upside if the thesis plays out. This is ThredUp Inc., trading under ticker TDUP, currently in the $7 to $8 range. ThredUp operates in one of the fastest growing segments of retail, online resale and secondhand fashion. They've built what they claim is the largest online consignment and thrift store for women, pets, and children's clothing, positioning themselves at the intersection of multiple powerful consumer trends: sustainability, value-conscious shopping, and the shift to digital commerce. Full transparency. ThredUp is different from our first two picks because they're still working toward consistent profitability, making this a higher risk, higher reward situation. But the growth metrics and market opportunity are compelling enough that serious investors need to pay attention. Let's break down the financial picture. ThredUp reported record full year 2024 revenue of $260 million, representing 1% growth year over year, with a record gross margin of 79.7%. In the fourth quarter specifically, they delivered revenue of $67.3 million, up 9% year over year, with gross margin reaching a record 80.4%. Those gross margins are exceptional and show the power of their business model. While they're not yet profitable on a GAAP net income basis, they've been making significant progress. Adjusted EBITDA from continuing operations was $5 million in Q4 2024, representing 7.4% of revenue, compared to $2.5 million or 4.1% of revenue in the prior year quarter. The trajectory toward profitability is clear, and management has provided a path to sustainable positive EBITDA. The business model is fascinating. ThredUp operates as a consignment marketplace where sellers send in their used clothing, and ThredUp handles everything: processing, photography, listing, storage, pricing, and shipping. They split proceeds with the seller when items sell. This creates a powerful network effect. More sellers mean more inventory selection, which attracts more buyers, which makes the platform more attractive to sellers. It's a virtuous cycle. ThredUp has invested heavily in automation and technology to handle this process efficiently. They use machine learning algorithms to predict which items will sell, automated photography systems that can process tens of thousands of items daily, and sophisticated pricing algorithms that optimize for both sell-through rates and revenue. These technological capabilities give them significant operational advantages over competitors. Here's where ThredUp's strategy gets really interesting. Their resale as a service platform. Through this B2B offering, ThredUp partners with major retailers to power their resale programs. They've worked with brands like Walmart and Vera Bradley, allowing traditional retailers to offer secondhand options to their customers without building the infrastructure themselves. ThredUp earns revenue from operating these programs, and this B2B segment has high margins while creating strategic relationships with major retail players. It positions ThredUp as potentially the back-end infrastructure provider for the entire resale market. In November 2024, ThredUp divested 91% of their European business to focus exclusively on the US market. This strategic decision allows them to concentrate resources on their core market, where they have the strongest competitive position. The market opportunity is enormous. Industry research suggests the secondhand apparel market could reach $70 to $80 billion in the United States alone over the next several years, growing significantly faster than traditional retail. ThredUp has captured only a small percentage of this market, meaning there's substantial room for growth. Consumer behavior is shifting dramatically, particularly among younger demographics, who view secondhand shopping not as a necessity, but as a preferred choice for environmental and economic reasons. ThredUp is leveraging generative AI to enhance the shopping experience, with AI search functionality driving higher conversion rates. They've introduced image search capabilities that allow customers to find items visually, which has become a default shopping method for many users and has led to measurably higher conversion rates. The company reported that new customer volume was up 32% year over year in Q4 2024, showing strong momentum in customer acquisition. For 2025, management is guiding for continued revenue growth with gross margins between 77% and 79% and adjusted EBITDA margins approximately flat to the prior year. They're reducing stock-based compensation by over 40% in 2025 to minimize equity dilution, which is a positive signal for existing shareholders. The company has ample capacity in their distribution centers and does not anticipate significant capital expenditures until at least 2027, meaning they can scale revenue without proportional cost increases. From a competitive standpoint, ThreadUp faces competition from other platforms like Poshmark and The RealReal, but their focus on automation, technology infrastructure, and strategic partnerships creates differentiation. Their resale as a service platform is something competitors haven't replicated at scale. Looking at ThreadUp as an investment, this represents the highest risk and highest potential reward of our three picks. The company needs to continue growing revenue while maintaining their path towards sustained profitability. If they execute successfully and the secondhand market continues growing as projected, ThreadUp could grow into a billion-dollar revenue company over the next 5 years. If they achieve that while maintaining strong margins, the stock could see multi-bagger returns from current levels. The risks include execution challenges, intensifying competition, macroeconomic headwinds affecting consumer spending, or the need to raise additional capital. However, for investors with appropriate risk tolerance who want exposure to the circular economy and sustainability trends that are reshaping retail, ThreadUp at current prices offers an asymmetric opportunity where the potential upside significantly outweighs the downside. So there you have it, 3 stocks under $10, each with unique characteristics and compelling investment theses. Before we wrap up, let me quickly walk you through this summary infographic that captures all the key information you need. Nokia, NOK, sector, telecommunications, infrastructure, 5G 2024, revenue, 19.2 billion, key strength, strong balance sheet, 3B euros, net cash growth, catalyst, 5G build-out, AI infrastructure, enterprise solutions. Analyst target, $7.50. Upside potential to $8.50. Risk level, low. Established, profitable, dividend-paying investment. Thesis, stable telecom infrastructure play with improving margins. Pitney Bowes, PBI. Sector, e-commerce logistics, shipping solutions. 2024. Revenue, $2.03 billion key. Strength, strong free cash flow, 370 MERT guidance for 2025. Growth catalyst, e-commerce growth, cost reduction program. 2025. Target, ADJ EBIT of 450 for 25% margins. Risk level medium, turnaround story, debt reduction, ongoing investment. Thesis, transformation to high margin logistics provider. ThreadUp, TDUP, sector, online resale, secondhand fashion. 2024 revenue, $260 million, 0.1% YOY. Key, strength record as 79.7% gross margins, AI-powered platform growth, catalyst, resale market expansion, RaaS partnerships. Market opportunity, 80B US market potential. Risk level, high, growth stage, working toward profitability, investment. Thesis, high growth play on circular economy trend. Conservative investors, start with Nokia for stability and dividends. Value investors, consider Pitney Bowes for turnaround potential with cash flow. Growth investors, ThreadUp offers highest upside with appropriate risk management. Diversified approach. Small positions in all three provides sector diversification. Remember, these aren't get-rich-quick schemes. They're calculated investment opportunities that require patience, conviction, and ongoing monitoring. Each of these stocks has the potential to double or triple from current levels if management executes on their stated strategies and market conditions remain favorable. As always, this analysis is for educational purposes, and you should conduct your own due diligence and consider consulting with a financial advisor before making any investment decisions. The beauty of stocks at these price points is that you can build meaningful positions without enormous capital requirements. And if even one of these works out as the thesis suggests, it could have a material positive impact on your portfolio returns. If you found this deep dive valuable, please hit that like button, subscribe to the channel, and turn on notifications so you don't miss our future analyses. Drop a comment below and let me know which of these 3 stocks you find most interesting, or if you would like us to cover any other investment opportunities. Thanks for watching, and I'll see you in the next video where we continue uncovering hidden value in the market.